In this video we are going to talk about retire early with dividend income. So before starting this video, please like this video and subscribe to this channel for our future updates. The most important thing for most investors is to have a secure and comfortable retirement. Many people's assets are placed in accounts that are specifically designated for this purpose. However, living off your money once you have reached retirement age can be just as difficult as investing for a good retirement in the first place. The majority of withdrawal procedures ask for a mix of spending interest income from bonds and selling stocks to cover the remainder of the withdrawal amount owed. This is the foundation of the well-known 4% rule in personal finance. The 4% rule aims to offer a consistent stream of cash to retirees while also maintaining a sufficient account balance to ensure that monies are available for use for many years. But what if there was another method to earn 4% or more from your portfolio each year without having to sell stocks and reduce the principal balance of your portfolio? Investing in dividend-paying stocks, mutual funds, and exchange-traded funds can help you increase your retirement income in a variety of ways. Over time, the cash flow generated by those dividend payments can serve as a complement to your Social Security and pension benefits. Perhaps it will supply you with all of the funds you require to maintain your pre-retirement standard of living. If you put in a little effort and forethought, it is possible to live off dividends. In contrast to bond interest, stock dividends tend to increase in value over time. One of the primary reasons why equities should be included in every investor's portfolio is because of this benefit. In addition, dividend growth has consistently outperformed inflation in the United States. For investors with a long time horizon, this fact can be exploited to build a portfolio that is solely dedicated to dividend income generating investments. People who are still saving for retirement can consider using their dividends to purchase additional shares of stock in the companies they invest in. As a result, they will receive even greater dividends and will be able to purchase even greater numbers of shares. Consider the following scenario. You purchased 1,000 shares of a stock that traded at $100 a share for a total investment of $100,000. Because the stock has a 3% dividend yield, you got $3 per share in dividends over the course of the past year, for a total of $3,000 in dividends. You then take the dividends and reinvest them in further stock, bringing your total investment to $103,000. Assume that the stock price does not fluctuate greatly, but that the corporation grows its dividend by 6% per year on an annual basis. You will receive a dividend yield of 3.18% on $103,000 in the second year, for a total dividend of around $3,275. However, this represents a yield on cost of approximately 3.28%. The yield on cost of this dividend reinvestment plan continues to rise over time as the dividends are reinvested. After 10 years, the hypothetical portfolio described in the preceding paragraph will provide around $7,108 in dividend income. After 20 years, you will get more than $24,289 in dividends every year, for a total of more than $44,289. What should you do if you are already retired? If you have a lengthy time horizon, compounding dividend income is quite beneficial. However, what if you are close to retirement? Dividend growth combined with a somewhat higher yield may be sufficient compensation for these investors. First and foremost, retirees who intend to live off their earnings may wish to consider increasing their yield. Most high-yielding equities and instruments, such as master limited partnerships, real estate investment trusts, REITs, and preferred shares, do not generate much in the way of distribution growth. Investing in them, on the other hand, will boost the present yield of your portfolio. That will go a long way toward assisting in the payment of today's bills without the need to sell off securities. Investors in their golden years should not shy away from classic dividend growth equities such as Procter & Gamble and Coca-Cola PG. These stocks will increase dividend income at a pace equal to or greater than the rate of inflation and will contribute to power income in the future. By including these types of companies in their portfolios, investors are sacrificing some present yield in exchange for a higher dividend in the future. However, while an investor with a modest portfolio may find it difficult to live entirely on dividends, the increasing and consistent payments might still help to reduce principal withdrawals. F's that pay dividends. It might be difficult to choose the best dividend-paying investments. Furthermore, attaining a proper level of diversification is significantly more difficult for small investors to accomplish. Fortunately, several exchange-traded funds, ETFs, implement dividend plans on your behalf. Dividend growth exchange-traded funds, ETFs, invest in stocks that are expected to increase their dividends in the future. A high dividend yield exchange-traded fund, ETF, is a preferable choice for investors seeking present income. When it comes to dividends, there isn't anything particularly special about them. If we look at dividend stocks as an asset class, we would anticipate them to provide long-term total returns that are not much different from those of the broader market over time. The most significant distinction is that income, rather than price appreciation, accounts for a greater proportion of the return. Retirement investors can benefit from this by reducing volatility and making it psychologically easier for them to stick with their plans during times of instability. In the event that your dividend income stream remains intact, and you are able to make ends meet without having to dip into your principal, you can take some solace in the knowledge that you are unlikely to outlive your savings or suffer significant setbacks even if the market performs poorly, particularly during the critical early years of retirement. For the most part, relying on firms that provide stable and growing dividends for retirement income alleviates many of the concerns associated with the ups and downs of the stock market. Incorporating a long-term investment plan that emphasizes dividend growth rather than the noise created by unpredictable stock prices is a good fit. It also reduces some of the emotional risks connected with investing, such as panic selling during downturns. While a portfolio of dividend growth companies, like any other equity-focused strategy, will suffer some fluctuations in market value over time, the income that a high-quality portfolio generates should grow steadily over time. Many investors prefer the simplicity of this strategy to a systematic withdrawal system for retirement income when compared to the latter. In your opinion, which situation sounds more stressful? The investor who relies on the cash flow generated and distributed by his investments each month, or the investor who must estimate a safe withdrawal rate in a variety of market conditions and then choose which assets should be sold in order to generate enough cash flow each year? Dividend income can make it simpler to stick to a plan in retirement since it provides passive cash flow without the stress of determining which assets to sell and when, which is especially important if another market disaster is on the horizon. In weak years, the emphasis can be on locating safe dividend payments rather than being worried with the market's price volatility and how that can affect your withdrawal amounts. As long as the dividend is not reduced, passive income continues to accrue, regardless of how the market is performing at the time of purchase. When it comes to investing in stocks, dividend payers frequently have features that appeal to conservative investors. For starters, a continually increasing dividend is sometimes regarded as a sign of a company's long-term viability, stability, and trust in its core business. In order to be able to pay a dividend on a consistent basis, a firm must generate profits that exceed the company's operating expenses. They are also encouraged to use greater caution when it comes to the use of currency. These parameters weed out many lower-quality enterprises that have too much debt, variable profitability, and insufficient cash flow generation characteristics that can result in substantial capital losses and significant fluctuations in share prices, and are therefore eliminated from consideration. When it comes to dividend-paying equities, retirees who are concerned about capital preservation will like their lower price volatility profile. Combining this with the strategy's reduced reliance on selling shares to make ends meet, dividend investing raises the likelihood of your principal being preserved and grown over an extended period of time. This enables you to leave a legacy for your family or for your favorite charitable organizations. The ability to sell assets when market conditions are good and you want to support special retirement activities is another advantage of dividend investing. Other options, such as annuities, often do not offer this level of adaptability. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.